In recent years, there's been an introduction of very high yielding exchange traded funds or ETFs that have opened the door to a lot of additional possibilities, including aggressively income harvesting, which is huge when it comes to dividends. So in today's video, we're going to be looking at 3 ETFs, which is going to be the QQQI, the JEPQ, and the SPYI, specifically looking at the dividend yields and how effectively these can be used. So let's go ahead and break them down. Let me hop over and add them to my stage so we can kind of see. And the first one we're going to be looking at is the QQQI. Now, this is award winner ETF of 2025. So the best new active ETF. So this could be one you absolutely want to look at. And all of these ETFs and the structure they have is relatively new. And we'll break that down. Now, one thing to note, this does track the NASDAQ 100 high income ETF. So it is based a lot in the tech sector. When we start looking at the NASDAQ, that is the very, very heavy focus on the tech sector, about 100 stocks that it holds in the portfolio. So you are not purchasing one individual company. You are buying and really going into a basket of companies. Now you'll notice on the right side, dividend frequency is every single month this is being paid, expense ratio of a 0.68, distribution rate of almost 14%. That is incredible with the distribution. So you are getting paid on a monthly basis. And of course, looking at the distribution rate, you have to break it out into the 12 months to see exactly how much you're earning from this. But I want to go over the strategy because this is the important thing to note. Now with these, it does come a little bit of a higher risk because of how they are kind of built and based on that monthly distribution that they have. So the benefits of this strategy: fund seeks to improve high monthly income generated from investments, which are the NASDAQ 100, and implement a data-driven call option strategy. Now, that is important to note that these are call options, data-driven call option strategies. We've seen these from a lot of different companies. This is how they are generating money, is the call options that they have in here. So they are also seeking to take advantage of tax loss harvesting opportunities. In addition to the index itself, a section of 1,256 contracts, which are subject to a lower 60-40 tax rate. Again, something to know when it comes to taxes, when it comes to tax harvesting. They are coming up with a lot of really cool ETFs that work incredibly well. Fund utilizes call option strategy that may include both sold and purchased NDX index options, which may provide the opportunity for upside in a rising market. That is how they generate income when it comes to these call options. So essentially, you're giving away the growth factor in return for getting and seeing the dividends on a monthly basis. Now, when we start looking at the price and the performance, I'm right around $50, and I believe they're all around $50, which we'll do a side-by-side comparison once we go through all 3 of these ETFs. Now, the second one, and you might be a lot more familiar with this, which is the JP Morgan version. Now, JP Morgan, of course, a massive asset manager, massive financial institution when it comes to Chase, the NASDAQ Equity Premium Income ETF. Now, right off the bat, this one does seem and has a very similar feel because this one tracks the NASDAQ as well. You'll notice right down here in the bottom right, it tracks the NASDAQ. So they are very similar. The ticker symbol on this is JEPQ, as we can see right there. So right here, the lead portfolio manager is experienced in investing in equities and equity derivatives. Underlying employs an additional data science, again, very similar to what we've seen with the QQQI, and looking at options, overlaying, implement, writing out money of the NASDAQ 100 index calls. So again, they're kind of doing the exact same thing. This one is yielding a 10.42. So it is a little bit lower than what we just seen with that the NASDAQ or the QQQI, but you can see 14% versus 12.42, and they're tracking about the same market. It shows competitively priced versus the peers at a 0.35. So it does have a little bit of a lower fee associated with it than we just seen. But looking overall at the performance, you can see right now the 30-day yield about 15.26%, gross expense of 0.35. So it is a little bit cheaper than what we just seen right here. On the expense ratio, this is a 0.68. So definitely notate that. Then the third one we get into, and probably the most risk focus, I guess, is the SPYI, which this S&P 500 versus the NASDAQ. So I'd say probably a little bit less risk, but notice distribution rate 12.11%. So we're still seeing a 12% growth out of here. Expense ratio, the exact same. So those NEOS funds are the 0.68. So a little bit of a higher fund than what we see with JP Morgan Chase, but overall looking at the details, and this is where it differs, is this tracks the S&P 500. That is the big difference, where when you start thinking again of the NASDAQ 100, really focusing on and building out a lot of the financial stocks, or excuse me, a lot of the tech stocks, and staying away from the financial. The S&P 500 has the 500 largest companies within the United States, and this is doing the exact same thing. It is covered in data-driven call option strategies to generate income on a monthly basis that is distributed on a monthly basis. So a lot of these you might not see a lot of growth of, but essentially you're giving up some of the growth to get some of the income generation itself, which is very important to know. So then we break it up and we do a side-by-side comparison, because this is interesting to kind of see the performance of how they kind of overlay and how they work. So looking at these, right, again, they're all right around $50. We have $50, $52, $50, or $49.23. So very, very close. Now, NEOS LLC, you'll notice the difference is how much they do have within the AUM. So 1.8 billion, 26 billion, 3 billion. So we know most of the NEOs are relatively new. Some of these funds have only been around for about a year, maybe about 2. And noticing in here, it says no underlying index, which is not true. This is the NASDAQ, this is the NASDAQ, this is the S&P 500, which literally has it in both of their names itself. But you'll notice the holdings. So even though both of these are tracking the NASDAQ, 104 for the QQQI, 93 for the JEPQ, and then 507 is the SPYI, again, because we're tracking that S&P 500 versus tracking the NASDAQ. Now, looking at the performance, this is where it's kind of interesting, because you'll notice QQQI, which is focused again in the tech sector with the NASDAQ, is a 1% return. You see the JEPQ 0.44, and then the SPYI is actually a negative 0.1%. So overall, seeing a okay return. But when we start looking at bigger picture, and this is what I like to look at, when you look at the QQQI, because it is heavily tech driven, 1 month we are yielding 7% versus a 3 and a 4.89. So even here, the S&P 500 outperforming a little bit, where the JEPI or the JEPQ is kind of underperforming a little, considering they both kind of track that NASDAQ, which is very interesting. So even here, we're up 1.76. This is -3, and this is a 0.03. Now, also remember, with the JP Morgan fund, this had the lowest cost basis, which again is kind of interesting to see that they are really underperforming. Year to date, up 2%, down almost 3%, and up 1.4. So again, the QQQI really outperforming. But then we look at the last 12 months. So the last year of performance, 15.41, 8.59, and 12%. So absolutely crushing what we're seeing with the JEPQ, with both of those NEOS funds doing incredibly well. Now, like we were talking about with cost basis, when it breaks it down, you can see there's no, it comes up with a bunch of errors, because these funds are very unique in the methodology and exactly how they work with these covered call strategies. We've seen it from Round Hill Tree. We've seen it for a bunch of different places. That we've seen a lot of these covered call strategies that are doing incredibly well. And even thinking of one more that I don't really want to cover, because it seems like when it's kind of too good to be true, but that is MSTY. Now, this one is yielding, and crazy enough, it is using options, or these really option income strategies, and it is using micro strategies, or now it is just strategy. They have yielded 143% distribution in the last 12 months. So think about that. With the distribution of micro strategies, they're doing option trading on a company like MicroStrategies or Strategy, because when you think of Strategy, they have an extremely volatile asset like Bitcoin, and they are doing options on the Bitcoin strategy. This is another one that Round Hill Tree did, doing those covered calls or those option strategies on there. So if there is a downturn within strategy itself, it could be absolutely catastrophic when you start looking at, a pullback of Bitcoin or pullback of the company itself, which again, if you want to invest a little bit into the Yield Max, I think it's Yield Max MSTR, but the ticker symbol is MSTY. So if you want to look at it, guys, definitely check it out. Again, It's very, very high risk, but high risk comes high reward. So if you want to put a little bit into it, you absolutely could. Eye-watering distribution rate, 143%, which is kind of crazy to think of how absolutely successful this option strategies have become. And it's honestly the last 2 years that we started seeing a lot of these from a lot of different companies. So, all right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.